Sometime after the ceasefire pause, Iran shot at somebody again. Oil's back above 85, and the Fed still has to decide by 2 o'clock this afternoon whether any of that changes its math. Good morning. It's Wednesday, July 29th. I'm Nick Vertucci with Eleanor Whitfield and Marcus Brooks. And given that this is quite possibly the single biggest day on the calendar all year for this market, we've pulled Dave Sullivan into the fourth chair. Chips, chips, and more chips. Dave, plus the 2 biggest earnings reports of the week landing tonight. Welcome back.
Thanks for having me. Wish my first day back was a quiet one, but that's never how it works out.
Morning, Nick. Morning, Dave.
Morning all. Forget the coffee cup. Bring the whole pot today.
Before we get into the tape, a quick note. Not a scoreboard update, because neither of you can actually be graded yet. Eleanor, your call on Warsh's statement language, and Marcus, yours on chips outperforming the NASDAQ. Both of those were calls on today. Today hasn't happened yet.
Right? We'll know by 2:30 this afternoon whether I'm right about the statement.
And whether chips actually hold up today, which given the last 48 hours is looking like a real fight.
So hold those thoughts. Regrade both tomorrow morning, full marks or full blame. For today, Eleanor is sitting at 7 and 5, streak of +2. Marcus is 5 and 9, streak of -2. Dave and Sarah are still at 0 and 1 apiece.
Lovely. I get to walk in already down.
You'll get your own call before we're done. Let's get into what actually happened Tuesday, because the headline number undersells a genuinely violent day underneath it.
It really does. The S&P 500 closed basically flat, up 3.68 points, 0.02% to 7,403. The Dow was the story, up 262 points, 0.5% to 52,210, on a wave of earnings beats from old economy names. The Nasdaq lagged, down 0.2% to 24,932 as the chip sell-off deepened for a 4th straight session.
And breadth was actually healthy. 7 of 11 sectors finished green. More than 380 S&P names were higher on the day. This wasn't a market saying no to stocks. It was a market saying no to one specific, incredibly crowded trade.
Which trade?
Semiconductors. AMD down about 8%, Micron down nearly 10%, Marvell off 7%, Intel down 6%, even Taiwan Semi and Broadcom slipping 3.5% and 1.7%. Nvidia itself only down about 1%, which tells you something on its own. Capital's narrowing even inside the chip trade, favoring the one name everyone agrees is the winner over the whole supplier chain underneath it.
And on the other side of that rotation, Coca-Cola on track for its best day since 2009 after a beat, Sherwin-Williams up 8.5%, IQVIA up nearly 14%. Money didn't leave the market Tuesday. It left one crowded corner of it for cash-generative, earnings-proven names. That's a valuation reset inside a bull market, which is a very different thing from the start of one ending.
The VIX
ticked up to 19 and change, a real move. Highest close in about a month, but nowhere near a stress reading. Options desks are paying up for protection quietly. That's healthy caution, not panic.
I'll agree with healthy caution today. No argument there.
And there was one more data point Tuesday that matters for this afternoon: consumer confidence.
And it came in soft. The Conference Board's index fell to 90.8, down from 92.2, below the 92.4 economists expected. The present situation piece fell for a 3rd straight month, and only about a quarter of consumers now say jobs are plentiful, the smallest gap between plentiful and hard to get since 2021.
Which, for what it's worth, is exactly the tell I said I'd need to take a surprise Fed hike seriously. A hot confidence number stacked on top of the oil relief. We got the opposite. Households are getting a little more nervous, not less. That's one more reason I still don't buy the 1 in 3 hike odds.
I'd read the same data point and land somewhere different. A softening consumer on top of ADP flagging slower hiring for a month now is exactly the kind of two-sided pressure that makes today's decision genuinely harder than hold and move on.
All right, that's Tuesday. Dave, let's get into the story that's actually eating the market alive right now, because it started Monday night and it's still going.
It's a genuinely wild one. China's state-backed DRAM maker, CXMT, debuted on Shanghai's Star Market Monday and surged as much as 465% on day one, an $8.6 billion raise, Asia's biggest chip IPO of the year, and it briefly put CXMT's market cap somewhere around $460 to $490 billion.
On paper,
Sure, but paper moves markets. Within hours, the entire memory complex sold off in sympathy. SanDisk, Micron, Western Digital, Seagate, SK Hynix, Samsung, all down hard. Some of it extending a slide that started Monday when Nvidia itself fell about 5% on reports it's exploring, guaranteeing up to $250 billion in financing for OpenAI's Ohio data center build-out, with OpenAI separately weighing something like $350 billion in Nvidia chip purchases on top of that.
And that's the part I keep coming back to. When the chip maker is financing its own customers' ability to buy the chips, you have to start asking whether the revenue underneath this whole trade is as clean as everyone's been assuming. That's not a valuation question anymore. It's a counterparty risk question.
I don't disagree that it's worth asking. I just don't think worth asking and the trade is broken are the same conclusion. The physical shortage is real. Morgan Stanley's own numbers have data center memory pricing up more than 25% in the third quarter alone. That's not a company inventing demand, that's actual scarcity showing up in actual prices.
give me the scoreboard on Korea specifically, because it sounds like this went from sector rotation to market event overnight.
South Korea's Kospi cratered over 10% Tuesday, worst session in years, trip to circuit breakers. Samsung down 13.5%, SK Hynix down almost 15%. And it didn't stop there. It's happening again today.
Today, meaning right now.
Right now. SK Hynix reported earnings this morning, and this is the part that should scare people more than a bad quarter would. It wasn't a bad quarter. Operating profit up 557% year over year, revenue up 257%, both records. And the stock's selling off again anyway because revenue landed at about 79 trillion won against roughly 84 trillion expected.
Wait, they set a record and missed?
Both true at once. That's what happens when a stock's priced for perfection. Expectations got so far ahead of an already record quarter that merely spectacular reads as a disappointment.
Which is precisely the KLA and Intel pattern from last week, wearing a different country's flag. It's not about whether the number's good. It's about whether it's good enough to justify the multiple everyone's already paid.
Fine, I'll give you that one. That is the same pattern, and it's now shown up in 3 separate markets in a week. I still think the underlying shortage is real. I just have to admit the market's gotten a lot less patient about paying for the promise of it.
So walk me through Micron, because from what I understand, it did the exact opposite of Samsung and SK Hynix on the exact same headline.
Same news, opposite stock. Micron's up more than 12%, trading near 971 on the very day the rest of the complex is in freefall. 2026's HBM supply is completely sold out, about $100 billion in binding multi-year contracts.
For anyone who doesn't trade chips for a living, what's HBM in one sentence?
High bandwidth memory. It's the specific, harder-to-make memory chip that sits right next to the AI processor and feeds it data fast enough to actually use it. Regular memory's a commodity. This stuff is the bottleneck everyone's fighting over.
Got it. Keep going.
Right. And UBS has a target on Micron of 1625, up from 535 back in May.
That's the bull case for the whole memory trade in one stock. Micron's graduated from a boom-bust commodity vendor into a scarcity price member of a 3-company oligopoly. The market's not contradicting itself by hitting Samsung and rewarding Micron. It's telling you contract visibility is what it's actually paying for right now, not just exposure to the theme.
I'd push back harder than same trade, different execution. Micron is up roughly 10 times off its own 52-week low. That's a stock already pricing in years of continued shortage holding. If the financing fragility story that just took 13 and 15% off Samsung and SK Hynix eventually catches up with Micron's own backlog, this isn't a stock that's immune, it's a stock that hasn't been tested yet.
I'll actually side partway with Eleanor there. I'd watch Micron's own print closely next quarter, because right now its story is being told by analysts raising price targets, and Samsung and SK Hynix's story is being told by financing fragility headlines and index mechanics. Those can swap places fast.
Let me push you for a second, Marcus, just to test it. Isn't the shortage as real this time? It's different. Exactly what everyone says about every crowded trade right before it rolls over.
Sure, that's a fair shot. The difference I'd point to is that this one's showing up in hard contract pricing, not just in a chart pattern. But I'll grant you it's the same sentence every overextended trade says about itself, right up until the day it isn't true anymore.
So is this a buying opportunity in the AI memory trade or the first crack in it? Because that's the actual question underneath everything we just said.
Buying opportunity. The shortage is a physical fact, not a sentiment. Prices are still climbing in the real world regardless of what CXMT stock does on day one.
And I think that's too clean. I think we just watched two separate anxieties: Chinese capacity arriving years earlier than anyone modeled, and real doubts about AI financing circularity collide on the same 48 hours and give momentum money a reason to finally take profits on names that had gone parabolic. Whether it's a crack or a buying opportunity depends entirely on whether SK Hynix's miss this morning is a one-quarter blip or the first of many. I don't think we know that yet, and I don't think anyone claiming certainty either way actually does.
That's a real split, and I'm going to leave it there rather than force a landing. Watch the next couple of memory prints, not today's stock moves, to find out who's right. Let's stay in chips but move to the equipment side, because Tuesday night gave us basically the same story with different tickers.
Teradyne and KLA both reported after the bell, minutes apart. Teradyne crushed it. EPS of 247 against a 209 estimate. Revenue of 1.33 billion against 1.22 expected, and then guided next quarter's EPS to as high as 215 against a street number of 144. Stock up 14% after hours.
And KLA beat on both lines too. Even added a $7 billion buyback and a 10-for-1 split, and the stock fell 10% anyway.
Why would a beat, a buyback, and a stock split get punished?
Guidance. KLA's fiscal 27 revenue outlook landed basically in line with what the street already had modeled. Call it 3.8 to 4.2 billion against a 3.91 consensus. In line isn't good enough anymore. Teradyne guided to acceleration. KLA guided to more of the same. The market paid for one and sold the other. Same night, same sector.
Which again, that's now the pattern of the entire week. Cadence beat and raised Monday night and got bought up over 4%. Intel beat bigger than anyone expected last week and got sold 8% because the spending behind it didn't look like it converts to cash fast enough. It's not about beating the quarter anymore. It's about proving the next several quarters are getting better, not just staying good.
I'd add the flip side though. Synopsys is higher in pre-market this morning purely off Cadence's read-through, plus its own news on an expanded NVIDIA partnership. So it's not universal punishment for anything AI adjacent. It's specifically punishing anyone whose forward number doesn't show acceleration.
And if you want a fourth example, Applied Digital's hosting revenue was up over 400% year over year the same week, and barely anyone's talking about it because it doesn't fit either headline as cleanly.
Hold that thought, Dave. We've got the Fed and two more earnings reports to get to before this show's over, and I don't want to lose the day ahead chasing a fifth data point. Quick pivot instead. All right, before we get any deeper into charts and trillions of one, Dave, this is your first morning back in a few weeks. Eleanor's on cup 2 of structured caffeine intake, week 2 of the program. Anything change on your end while you were off the show?
Honestly, I switched to decaf for exactly one day last week out of curiosity and immediately regretted every decision that led to it.
The bravest thing anyone's done on this show all month.
Structured caffeine intake doesn't include decaf, Dave. That's a different program entirely.
Noted for the record. Back to the tape. Let's zoom out to the rest of the world, because Tuesday was genuinely strange outside US borders, too.
It really was a split screen. Seoul had one of its worst sessions in years on the chip route we just covered. Tokyo's Nikkei fell close to 4%. And yet Frankfurt closed higher, the Stoxx 600 eked out a gain, Sydney's ASX rose 0.5%. That's not global risk-off. That's a violent, narrow unwind in one crowded regional trade colliding with a currency market telling an entirely different story.
What's the currency market saying?
The dollar's the thread tying all of it together. The DXY sat near a one-month high around 101.5, and the yen printed its weakest level against the dollar in roughly 40 years, trading near 163, 164.
A 40-year low is a real headline, but I'd frame it as a rates differential story more than a Japan story. Japan's policy rate is still miles below the Fed's, and every basis point the Fed holds onto today widens that gap further. It's mechanical, not a verdict on the Japanese economy.
Agreed on the mechanism. The white flag the read-through. A dollar this strong into a Fed decision would normally be read as hawkish and risk negative. Instead, European equities are near multi-week highs, and oil had been falling into Tuesday. Global markets were running two narratives at once, and today's Fed statement is genuinely the thing that decides which one was right.
Emphasis on had been falling because that part just changed overnight.
Which is exactly where I want to go next, because a lot changed between last night and this morning. Walk me through it.
Iran carried out what's being described as an attempted surprise attack overnight, the first direct engagement since Friday's pause. Oil responded immediately, Brent's up more than 3%, back near 85 a barrel.
And I want to be very clear, this is exactly the scenario I laid out yesterday. Not as an I told you so, but because it matters for how we all read the next 24 hours. I said a pause with an explicit resume if it fails clause isn't peace. It's a ceasefire on a short leash, and that one credible strike undoes the de-escalation trade in an afternoon. That's roughly what just happened.
I'm not going to fight you on that one. 2 days of oil grinding lower just got partly unwound overnight. I'll take the loss on the optimism, though I'd still separate the risk premium is back from the war is escalating structurally. We don't have enough this morning to know which one this is yet.
What does a resurgent oil price do to a Fed that's already deciding today?
It complicates Warsh's job further, not less. He's spent the month drawing a line between energy-driven price moves and the underlying inflation fight he says is still too high. An overnight spike doesn't erase that distinction for him, but it does make it harder to sound as calm about the temporary framing in this afternoon's press conference.
So where did the actual numbers stand walking into 2 o'clock?
CME's Fed Watch had traders around 70% odds of a hold this morning, call it 30% on a hike. That's up from about 12% a week ago, before oil started moving. So it's still a hold, most likely, but a genuinely less comfortable one than anyone expected when this meeting was scheduled.
Give me the stakes in plain terms. What actually changes at your desks if he surprises everyone with a hike at 2 o'clock?
Every rate-sensitive trade that's rallied this month gets repriced hard and fast. Small caps, REITs, anything that just caught a bid on rotation out of chips. It would be the loudest possible signal that Warsh means inflation's still too high, literally, not as a talking point.
And I still think it's the less likely outcome by a wide margin. Labor's softening, consumer confidence just missed, and surprising markets hours before Microsoft and Meta report is a strange hill to die on. But I'll admit the overnight Iran news moved my own confidence from he's basically certain to hold to he's very likely to hold. That's a real shift, even if the headline conclusion's the same.
And futures are, where given everything we just described.
Barely moved. S&P futures up about 0.2%. Dow roughly flat, NASDAQ slightly lower, which is its own story. A market that absorbed an overnight attack, a fresh leg down in Korean ships, and a live Fed decision, and shrugged at the open. That's either total confidence or total exhaustion, and I'm honestly not sure which.
Let's get to tonight, because whatever the Fed does at 2, the market's not done with this day until after the closing bell.
Microsoft and Meta both report after the close. Microsoft's expected around $4.24 a share for the fiscal fourth quarter, revenue near $87.6 billion, and the number everyone's actually waiting for isn't the quarter that already happened. It's the first real framing of fiscal 27 capex, after roughly $72 billion already spent in the first half of this fiscal year.
Meta's the same setup from a different angle. Consensus is around $60 billion in revenue, up 27%, operating profit near $21.5 billion. They already raised this year's capex range by $10 billion last quarter to about $137 billion. Industry-wide 2027 capex consensus is now pushing toward $878 billion across the sector.
And both of them are expected to beat the quarter itself.
Something like 95% odds priced in on both beating, from what I've seen. Which means the quarter's basically a formality tonight. The stock move lives entirely in the capex sentence.
Which brings us right back to where you two left it yesterday and haven't moved an inch since.
And I'm exactly where I was. Intel's reaction last week, KLA's reaction last night, SK Hynix's reaction this morning. 3 separate proofs in 3 days that the market will punish spending that doesn't obviously convert to cash on a visible timeline. Alphabet already went cash flow negative and got sold for it. I think tonight at least one of these two gets the same treatment.
And I'm still on the other side for the same reason I gave yesterday. Microsoft and Meta have real profitable engines funding the spend. Azure and the ad business. That's a fundamentally different balance sheet than a chipmaker funding its own foundry or a hyperscaler with one specific negative free cash flow quarter. I don't think tonight looks like Friday.
I'm not going to make either of you fold. That's a real disagreement, and forcing a fake handshake on it would be dishonest. Here's the marker for anyone listening. Watch the stock reaction tonight, not the headline beat. If both sell off hard despite clearing the bar, Eleanor's read is confirmed. If either one holds or rallies on a raised capex number, Marcus's distinction is holding up. We'll know before tomorrow's show even starts. All right, closing calls, one apiece, checkable by tomorrow morning.
Mine's on Meta specifically. If it sells off more than 5% tomorrow morning on the capex number, that's the market extending Friday's Alphabet verdict to a second hyperscaler, and I think that's the confirmation my case needed.
Mine's on Microsoft. If Azure growth holds in the high 30s% and the stock closes flat or higher despite a big capex number, that's proof the cash-generative hyperscalers get treated differently than Alphabet was. Exactly the distinction I've been drawing all week.
And mine's on the chip complex, since that's what I'm actually here for. If the semiconductor ETF, ticker SMH, closes positive today despite the Fed and the Korea overhang, I think the 4-day rout found its bottom. If it extends to a 5th or 6th red day, the memory unwind's still got real room to run.
3 checkable calls, all resolving by the time we're back here tomorrow. So here's today, a Fed decision at 2 o'clock with real odds of a surprise for the first time in months. Microsoft and Meta after the close deciding whether last week's AI capex verdict was a one-company problem or a sector-wide one. A memory chip complex that's cracked in 3 different countries in 3 days, and an overnight Iran attack that just put the oil story right back on the board. Dave, thanks for pulling extra duty on your first morning back.
Anytime, well, maybe not anytime. Ask me again after tonight.
Fair. If the show's useful to you, follow Nova Ventures Daily wherever you get your podcasts, and catch our live takes all day at Nova Ventures GE on X. That's your Wednesday morning brief. Have a great day, and we'll see you tomorrow.